Good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, November the 6th, 2025. Okay, guys, I want to start off by looking at the bond market, especially the long end of the bond market. Quite interesting price action. As we can see here, the bond market's been at the long end quite a lot under pressure and quite a big down day yesterday. Although it is getting to quite an interesting technical level here, quite a lot of support there at about the 115.28 level, 27 level. What's been causing this? I mean, obviously, the bigger picture is Powell's sort of recalibration, his comments after the FOMC last week that, a cut in December was not a foregone conclusion, far from it. And the market has just generally repriced hawkishly, both at the front end and also the long end. But the sort of the proximate causes here is that we actually got some quite strong data yesterday, which we'll look at. But before we look at that, we had the QRA, which is kind of interesting because it was they essentially said, and let's just look at the key paragraph here. There's a couple of ways of interpreting this. This is a quarterly refunding announcement for the size of the auctions. And as you can see here, it says the Treasury believes its current auction sizes leave it well positioned to address potential changes to the fiscal outlook. Potential changes to the fiscal outlook. That could also be sort of income coming in from tariffs. Based on current projected borrow, Treasury anticipates maintaining nominal coupon auction sizes for at least the next several quarters. So the next several quarters. So one way of looking at that is saying, hey, for the next year or so, 9 months, 12 months, 15 months, the Treasury doesn't believe it's going to increase auction sizes, and therefore that's a positive for the long end of the yield of the bonds. Any sort of extra issuance required, they've signaled that they're probably going to go for about the front end of the curve with bills. And keep in mind that at the moment they're at about 20% of issuance is bills. Historically, that's been around 15%. So they're already about 5% above the historical sort of average of bill issuance. But that seems to be what Besant is comfortable with. But what got the market's attention, possibly as a small factor, was this: looking ahead, a bit vague, looking ahead, Treasury has begun to preliminarily consider future increases to nominal coupon auction sizes, with a focus on evaluating trends in structural demand and assessing potential costs and risks of various issuance profiles. So this is interesting because this is new. They're starting to consider future increases to coupons, which of course is the longer term bonds. So that's a little bit of a negative for the bond market. We also have the situation, as we all know, although this is going to be a bit more of a slow burner, is that we heard yesterday the first of the arguments, the oral arguments and questions from the justices at the Supreme Court of the United States about the legality of Trump's sort of tariffs. And it seems to be the initial sort of an analysis seems to be that the justices were a little bit skeptical and not necessarily convinced that tariffs are not in the purview of the Congress, and they're a bit skeptical that the president, that this is indeed a true emergency requiring sort of unilateral decisions from the White House. So it could be that the justices of the Supreme Court roll back the legality of those tariffs, but that's probably going to take several weeks, if not months. And could it be there that that means that tariff income would have to be somehow returned back to sort of importers and consumers, and that there would be less income coming in from tariffs if they're ruled illegal, therefore more bond issuance. So putting that all together, just going back to the chart here, which we'll do in a second. If I could find it, yeah. So if we go back to the chart here, that also sort of underscores why we had a pretty chunky sort of sell-off at the long end of the curve. So let's now look at some of that data, because the data over the last 24 hours has been a little bit ambiguous. And keep in mind, we are lacking official US government data. So what the market is trying to do is to cobble together interpretations from a bunch of different private sort of surveys and whatnot. So initially, yesterday morning at about 8:15, we now have the ADP. It used to be sort of a monthly number, three days before or 2 days before the non-farm payrolls. Now it comes out every Wednesday, and it's kind of like a 4-week moving average. And what we can see here is like 42,000. And keep in mind that the longer term moving average is, for this number, has been about 150,000 or so. So it's kind of interesting because we definitely seem to be having a slowdown in the labor market. But on the other hand, even people like Jerome Powell are saying that the replacement sort of number of jobs required is much less than it was, let's say, a year ago, because there are simply not as many immigrants coming into the country, documented or otherwise. And therefore, the real sort of replacement number required is 30, 40, 50,000. So one could argue that this number, although it looks weak, is not necessarily signaling a higher unemployment rate. But what is interesting is just to see here that the average does seem to be over time going down. From plus 100,000 now down into 30, 40, 50,000. And it's also interesting to see where the jobs are coming. You can see here that the small and medium, so the orange and yellow here, the small and medium-sized companies are actually losing jobs. They're shedding jobs. So the number of new jobs created overall, it's really coming from these large companies who are able to survive. So it does seem that small and medium companies are pulling back, maybe under pressure. Again, difficult to draw too many conclusions, but it does seem that overall, even in this sort of noisy ADP number, that the job market is weakening a little bit. If we look here at this is like a rolling 3 month basis, you can see here that the ADP number definitely is, sort of slowly going down. So whichever way you look at it, it does seem to be weakening. On the other hand, we did have some, relatively strong data from the ISM services. Now, the methodology of this is a bit problematic. A lot of people say that it doesn't actually really give a correct signal, but nonetheless, with this sort of lack of government data, we have to look at that. So if you look at the ISM services, you can see here that it was, above consensus. It came in at 52.4. Consensus was 50.8. So it definitely came in, in expansionary territory. So that's a positive. If we also look at the new orders, we can see that the new orders was actually pretty good, over 55. So that's sort of a positive. Now we can see that the employment aspect of that was below 50, so in contraction. Remember, if it's below 50, that means things are technically getting worse, although less worse, so to speak. So, that's sort of a mixed message there. But definitely, what was sort of problematic, probably from the Fed's point of view, if you look at the prices paid, you can see here up to 70s, and a lot of respondents to the survey cited tariffs as basically the biggest problem, so causing the price input to be going up. So we have a picture here of sticky inflation, and let's just say I would say three things. So sticky inflation, economy which was okay, but a labor market which is sort of falling, which is it definitely sort of seems to be sort of flat or maybe even weakening. But we got a contradictory bit of information just this morning, about 6 o'clock or so. We got the Challenger job layoffs, and these were actually pretty horrible numbers. So if we actually look at them, you can see here there's about 150,000 job cuts in October. And as we see here, the highest October total since 2003. So this is not great at all. And if you actually look here over the sort of the yearly number in this dark blue here, you see this dark blue here, the number of, this is layoffs. So this is people being fired. We know all about that. So people being fired, you can see that this number, as we can see here, is going a lot higher. And so is this starting to indicate really that, things are definitely getting worse? And you can see here that the year-to-date total is over 1 million. And again, if you look at this on a yearly basis, you can see that for 2025, this is not great. This is really pushing a lot higher. So that does seem to be sort of indicating that the labor market is weakening. And so on the back of that, let's just go back and look at a few charts here. You can see here this morning that if we look at something, you can see here that now the ZB, so the 30-year bond, actually probably more accurately a 15 to 20-year bond, has actually made some gains. If you look at the front end of the curve, let's say the ZT, which is the 2-year, you can see that it's sort of bounced off. So the bond's getting a little bit of a bid this morning. We can look at the US dollar. If we look at the dollar index, and you can see here, quite interesting, it's been rejected, and that's possibly on the front of this pretty bad Challenger job layoff numbers we've got early this morning. Also, technically, you can see here this purple line, which is the, as you guys know, the 100 here, and this overhead resistance, and basically like a big sort of Fibonacci level here as well. Let's just put it back On here, we'll draw it down to this one. So essentially, you're around about the fib level, which is overhead resistance. The dollar just taking a bit of a pause. It's still not a huge sell-off in any sense, but just taking a pause here. And you know, on the back of this relatively negative data yesterday. One thing I just also just want to have a quick look at is looking at some charts here. The Aussie New Zealand, the Australian dollar at an interesting level here versus the New Zealand dollar. You can see here that this is quite a key level up at about 115. I think even if we go back to get up there, yeah. So you can see here, I actually put it on the weekly. So if you see on a weekly chart here, you see just what an important level this is. So this is like a triple top at the 115. So the Aussie is actually, just been in this huge range, grinding its way up. But the point is, if this can break through, there's plenty of upside here. Now, I'm not sure if it is going to break through, if it will be able, because it's had a nice sort of run up. But if you look at this chart, this is a very bullish chart. Obviously, all moving averages. We had some kind of bullish pennant or flag or whatever you want to call it here, pushing higher, just pausing. But this looks as though it wants to go higher. So why would that be? We have fairly divergent economies and also monetary policies. We have the Reserve Bank of New Zealand that they just got employment numbers in the last couple of days, which were pretty awful. The governor of the Reserve Bank of New Zealand saying that monetary policy may have to be even more accommodative. Still very worried about trade and whatnot. So the New Zealand economy does seem to be sort of quite weak at the moment, and the monetary policy is being quite accommodative. On the other side of the Tasman. The Tasman Sea in Australia, you have still sticky inflation. You have the Reserve Bank of Australia, we saw just recently holding interest rates and signaling possibly less cuts to come in the future, and an economy and employment situation which is relatively robust. So we're getting divergent economies, divergent monetary policy, and really being played out in this chart here. So interesting to see if this just sort of fiddles around here and sort of does a sideways consolidation, or whether this pushes actually a lot higher into all of that sort of air pocket above. So that's an interesting one. In terms of the equities, let's just have a quick look here at equities. We see that VIX still at relative, I don't want to say elevated levels, but not at 13 or 14 or 15, still, around about 18. So that's indicating, about 1.1, 1.2 implied volatility move every day, although it has come down a little bit. So if this continues to come down, we may see equities, that's a bit of a tailwind. And this is quite an interesting chart here because obviously, there was concerns about Palantir and sort of forward, evaluations being too hot and whatnot. But just from a technical perspective, if I put this on, let's say, break it down to a 4-hour chart, just for a little bit more granularity, this, one could argue that there's not a huge amount of technical damage. And one could argue, let's say, if we throw on a Fibonacci here, you could say, well, hey, it came down to a 50% retrace, pretty strong rejection candle here. Could one argue that this is some kind of bullish flag or pennant, and this is ready to potentially break higher again and maybe sort of retest the highs? I'm just trying to make the point that there's always a narrative which can fit, is evaluations are too high, sure, but why today? It's an interesting one here because this chart is still very, very bullish, and there's really no technical damage. If we just throw on some exponential moving averages here, you can see that we haven't even really we've just touched a few times the 20-day. We just had this sort of sell-off, a couple of weeks ago down to the 50, but above that, anything above the 50 has still been very, very supportive. So at this point, you have to say, just from a purely objective classical technical analysis point of view, that there's been zero technical damage done and the equities are still looking strong. Is this an attractive place to buy at these valuations? Possibly not, but it's also possible that CTAs and momentum kind of sort of funds are still in this trade and still grinding higher. And if volatility continues to reduce, some of the vol targeting funds are also going to be comfortable, incrementally increasing their holdings here. So that's interesting there. Apart from that, I just want to have a look at the oil chart as well. Oil's an interesting one. We got the official government inventories yesterday morning. They were they weren't great. We had builds in the crude, but on the other hand, the gasoline was a draw, so that's maybe not too bad. Pretty interesting level here. You see here, this is just come back to a sort of a Fibonacci retracement here. Is this some kind of sideways consolidation ready to break higher? who knows? We had the official selling price of sort of the Saudi oil into Asia released sort of overnight, and that was reduced. So the official OSP, so the official selling price of the Saudi products, as I say, was reduced. So that seems to be an admittance by the Saudis, at least, that the market is not super tight and they can't sort of charge top dollar literally for their product. So I don't know. I just think that this is probably going to be grinding in a sideways range. I don't see anything massively bullish at the moment, but then again, nothing necessarily massively bearish. If anything, it may just sort of drift down. So maybe sort of selling call spreads would be my preferred way to express that. I think I'll leave it there, guys. Today, as I say, we have more arguments, I think, at the Supreme Court. We also have quite a lot of Fed speakers. We have Waller, Williams, and quite a few others. So let's sort of try and put all that together to see how they're all feeling about the this December cut, and trying just to sort of draw some conclusions from this sort of patchwork of data which we are receiving. Okay, thank you for that. Have a great trading day, and we'll continue this tomorrow. Thank you.